As we have been talking so much about the VIX and the decline in the VIX and the sort of debate over the usefulness of the VIX, you've also brought back something that we haven't talked about in a while in your note to me today, which is that we have not had very many plus or minus 1% moves this year, which is basically another way of saying volatility has been very low. But what do you make of it?
Yeah, it's pretty telling. I mean, if you look right now, people talk about VIX being below 10, but what they should really focus on is actual or realized volatility. It's actually fallen below 6. So even though the forward looking's at 10, we're not actually seeing the volatility, and that's because we haven't had 1% moves in either direction. We're supposed to have them just about 22.5% of the time. If you look over this year alone, 87 trading days, it's only happened 3 times, and that's pretty interesting because people need to focus on what is VIX. VIX is actually looking at the volatility of large cap stocks. Now, large cap stocks have a lot of tailwinds behind them, whether it's with the new administration and their fiscal policies, whether they're doing well overseas because a lot of the revenues come out from overseas, whether sector correlations have diverged. So you're having cyclicals counteract the non-cyclicals. So there's a lot of underpinnings that have made this VIX low, as well as the actual and realized.
Okay, so I want to get to your trade, but first, just quickly, should people then be worried about these various breakdown in correlations, about the low VIX, about the low realized volatility? Is it cause for concern?
No, they should start looking at other indicators to see where volatility is. You look at the Russell 2000, it's above 15.5, the volatility there. Look at the energy sector. The energy sector, the XLE ETF, its implied volatility is 18. You can also look at financials, it's above 16. So there are sectors underneath that actually have that volatility because, as we said, there's sector dispersion now, which is lending to the credence of the low overall market volatility.
All right, let's get to your trade of the day. This is certainly a large cap stock, if you're looking at the VIX weighted towards large caps. Disney, which is out after the bell. We've been talking a lot about looking ahead to the earnings. Do you not think they're going to do terribly well?
Well, one of the things you want to do in a low environment like this is see what you can do for portfolio insurance if there's a lot of uncertainty. And so what you can do is, for Disney itself, is you can go out to July, and for only about 2.4% of the underlying stock price, you can actually hedge the 110 put. You can buy it right there at $2.65. So you can have unlimited upside if you own the stock, or if you're bearish, you can just buy the put here because we know what's happening. I mean, Scarlett highlighted earlier today and last night on the numbers about subscribers and cord cutting, right? So that's a big concern. The succession issue is a giant concern. ESPN has really weighed on them and the sentiment. So we're going to have to see what happens because Bob Iger is bullish on ESPN. He said it numerous quarters ago, and it has not panned out. And he's going to be at the helm at least till 2019. So they need to figure something out, and they need to figure it out soon. And at least they have the movie studios behind them. But how long can that play out? Who knows?
Right. So either way, you get a little insurance there with that put.
Yeah, it's a cheap insurance policy, and investors should start looking at this because because you can get the upside that you want. And the stock is up 7% year to date. Last quarter, it moved 0% on earnings. It didn't move either way. This way, you can protect yourself even in market downturns because it goes out to July.